Hey all, welcome back to Share Track. We're back with a fundamental analysis about a company we've done before, but we'd like to revisit. So let's get started. Now, we covered this company about 5 months ago, close to where we were in the winter. And back at that time, this company, Oracle, was trading at close to about $100, a little over, a little under, around that $100 a share range. And what we discovered at that time, after doing a little bit of fundamental analysis, looking at their margins, looking at their balance sheet, looking at their earnings, we thought it was a pretty good deal. We thought that what they're doing with AI, what Oracle's doing with their cloud revenue looks very positive and very bullish. And since then, it reported earnings, huge beat on earnings. The company reported a big uptick in cloud revenue, in licenses revenue, very positive for the company. And since then, it's appreciated close to that $130 a share range. So if anyone picked it up, good for you. You're probably really happy. But we'd like to see, is the company still doing well? Is it still a good deal? And what's going on? What's new? And what can we expect in the future? One of our very astute viewers on this wonderful video that Raj did comparing two software as a service companies, Palantir and Oracle, our astute viewer pointed out in the comments that Oracle has about $100 billion in debt. And I want to take a look and see, is that true and is that a problem? Very close, by the way. The company has about 89 billion dollars of debt on its balance sheet, which a very large sum. So that is something to be worried about, and I don't blame the viewer. That is a great observation. But I'd like to introduce the audience to something called it's something that a lot of fundamental analysts used, which is called the weighted average cost of capital, the WACC, WACC, which it's a very long equation to figure out this WACC, weighted average cost of capital. It's something fund managers use, which this weighted average cost of capital determines how much equity holders, how much debt holders want to achieve on their debt in order to be satisfied. I'm not going to bore you with the formula. I've just got the numbers for you. The weighted average cost of capital on the equity is 9.9%. And right now they have 77.7% of their total capital in equity. So multiply that by that. The equity holders, in order to be satisfied, expect a return of 9.9 because of the amount of equity, 7.7. That is their weighted average cost of equity. Their debt, they have 22.3% of their capital structure in debt. The debt holders expect a return of 6.1%, given in 1.9. Weighted average cost of capital for Oracle is 9.0%. All you need to know is this is what a lot of fundamental investors think as the discount rate. They expect this to be the minimum sum that Oracle needs to achieve in order for the holders of debt and holders of equity to be happy and satisfied. If it achieves lower than this, then it's likely that the stock price will go down. If it achieves greater than this, it's like the stock price were to go up. So here's another little fun thing. I'm not going to bore you with the equation. It's very long and complicated. But just think, whenever you hear something like weighted average cost of capital, that's something seen as the discount rate, what holders of the capital structure want. So is Oracle able to produce this 6.1% for their debt to keep all the debt holders satisfied? Yes, they are. And another thing, not all debt is always bad. because when a company borrows, they are able to write that debt off of their against their revenue. And looking at Oracle's balance sheet, they make, pardon me, $3.75 billion in operating income. And their interest expense is 876 million. They are able to write off all of that interest expense, meaning that their debt isn't always a bad thing because they have the revenue to write off for that. So, although you ideally want no debt, it's not the worst thing in the world for Oracle because they're able to use it as an advantage for growing the company. But another thing I do like to look at is the interest, is the debt they're paying, is the interest they're paying on the debt, is it positive or is it negative? One company, Microsoft, they're making much more money lending out than they are actually borrowing. Like Microsoft's balance sheet, they are making $100 billion just lending out money, and they're only spending half of that borrowing. Oracle, on the other hand, it's not necessarily the case. Oracle, their interest expense, 876 million. However, their interest income, on the other hand, is significantly lower than that. It is, pardon me, interest income is, pardon me, 485, so less than half of that. That company, that tells me that it would be ideal to pay off much more of the debt. So our viewer, you are correct. Debt could be a big problem because they're paying out more in debt than they are coming in. However, operating revenue is greater than. So what's going on with Oracle? What's nice with Oracle? From their balance sheet, they delivered a great earnings because, as we were saying earlier, their cloud revenue, huge uptake. However, they did say something really intriguing on their earnings call. They said that they expect cloud revenue to continue to increase because Oracle expects most of its clients to renew their licenses, and Oracle expects to acquire more clients through things like advertising, but they're investing significantly more money into research and development to deliver a better experience and remain competitive. That software as a service space is very competitive nowadays. So Oracle wants to remain one of their leaders, and they think they could do that because they have cash. Speaking of cash, on their balance sheet, their free cash, $3.8 billion, quite a large sum, and nearly $9.5 billion of cash on their balance sheet. What they also said is they're open to looking to acquire new companies and acquire some of these undervalued companies, which they got a lot of cash. They're cash rich, so why not? It'll be a way to be more competitive and maybe do something where they can pick up someone who could be a competitor in the future, or somebody who some of their competitors might also be eyeing, and they could probably provide them with a competitive advantage. So nice little look at Oracle over there. I'd also like to share. I've gone ahead and I'm just going to increase the size of this. I've gone ahead and done a quick little ratio analysis. You don't need to pay attention to everything here. I just want to show that the profit margin has increased quite a bit in that latest earnings call, but is expected to increase even further. This jump from 20% profit margin to 31 is one of the reasons why Oracle saw that huge jump of over 10% on that earnings. And because their EPS expected to rise even further, the forward PE is becoming much more favorable. In fact, better than most of its competitors, which, way to go, Oracle. But this is a little bit of the issue. The interest expense, that is really, really high. They're paying a significant sum of interest expense, which is expected to rise even further because they're taking on a little bit more debt. And the income coming in, it's smaller than the amount they're spending on that interest. So they do have a little bit of a debt issue right now. It is contained. They are able to keep it within, they're able to handle it, but it's something to continue looking at, where if their revenue were to decline, this could be an issue in the future. So is Oracle a good deal? In my opinion, Oracle is an okay deal. Back then, when we covered it and it was less than $100, it was a phenomenal deal. Right now, it's gone up a little bit. And one thing I discovered, which I'd like to share, is this PEG ratio sheet. Right now, Oracle has a price of $125 a share. Its forward earnings, which is similar to how we did it last time we did an analysis, 5.57, meaning their forward PE is a little bit higher than the bargain range it was before. However, their expected EPS growth of 14%, now I calculated about 12%, because a lot of that growth they were expecting was pushed forward, meaning it became priced into this price. Now it's expected, instead of growing the great 17%, growing at 12%, which is still great. It's still in line with what's going on with the S&P 500. The S&P 500 has a PEG ratio of about 1.7, meaning this is sort of in line with the S&P 500, meaning it's an okay deal, it's a good deal, but it's not the bargain bin deal it was a short while ago. So Oracle, I do like it, but if this price were to come down, if it were to, let's say, I don't know, reach the $110 range, all of a sudden, we're trading at a PEG ratio lower than the S&P 500 index. And Raj and I were talking, we were taking a look at a little bit of the technical analysis side. And what we starting to see is Oracle is starting to get close to that lower end of the earnings price gap. And if it were to go and try and fill that gap and were to come down into that, maybe that $110 range, maybe roughly around 112, that whole area, I think Oracle would be a nice pickup at around that price range. So if we were to get a discount, if we were to pick it up for a lower price, Oracle's a good buy. I think debt problem is a problem. However, they're able to handle it and contain it right now. They have cash. Their balance sheet risk is quite low. In fact, they have so much cash, they're looking to spend it to picking up some of the competitors. So I want to know, everybody out there, what do you think of Oracle? They put together a cool restructuring plan, which they said, this is how we're going to become much more efficient. But let me know what you think, everybody. What do you think of Oracle? I like it if it were to get a little cheaper, but let us all know what you think. And thank you very much. Hope to hear from all of you in the comments, and let me know what stock you'd like to cover next. So thank you kindly, and until next time, see you, friendos.
Hey, Sandeep. It was a amazing, amazing coverage. I just wanted to add a few things, because I have found where their 83 billion, 73 billion debt comes from.
Yes, yes.
It's
Come
very
on.
intriguing. So I'm going to share a particular screen with you, which shows. So this is the article. At Oracle, net debt and a 75 billion argument that stock buybacks can go too far.
Hmm.
So Oracle's 75 billion stock buyback binge was partially financed with bond issuance, and the software giant now has net debt, and bond agencies have downgraded it. So this article is from December 5, 2019. So basically, they have gone for a financial leverage where the interest costs are fixed. Anything above that they get, it can boost the dividend on the lower number of shares.
Mhm.
So that's what I think they have done. So that's my finding.
Nice.
Yeah.
Um, Actually, Raj, since we're here, any chance you could show the viewers what we're looking at with that bottom gap fill?
Sure. Sure.
With
Sure. Yeah.
I
Give me
found that
one
really
second.
interesting when we take a look at that.
Definitely. Definitely. We'll go here into
Yeah.
Oracle. Are you able to see the trading view
Yes,
chart?
yes. You can see. So ORCL, fun company.
This is the gap up we had with the earnings. This is the gap we are talking about, right, Sandeep?
Mhm. We're getting closer to that lower end of the gap. So if that gap were to fill,
Yeah.
those bottom level prices seem much.
So I'll just draw a trend line so you can see where you are talking about here or here? Here, right? This is where
Yes.
I'll look at. So that's around $114
Mhm.
because right now the MACD is moving away from the signal line. So it's on a bearish trend. But this one, the momentum just picked up. And today, already in the morning, pre-market, it's down minus 0.23%. So I think it's going on a bearish trend. So
Mhm.
it will most probably fill up this gap in the next week or so, unless there's a positive catalyst. It should
Uh-huh.
start coming down.
Hey, I like Oracle at those lower level ranges. That would be a nice pickup where the company's doing okay.
Right. And I think I don't know what interest they are paying on those bonds that they issued. So that's also another factor. We are in a high interest regime. So if they have been paying lower interest and now they have to refinance, then that could also put a big dent on their profitability because they'll be paying more interest. So that's also likely to happen. I don't know. I'll have to check it out and see.
The average interest is roughly around that 6% range.
Wow, that's heavy interest.
Yeah, they have laddered interest where they issued bonds at different points of time. Some of their bonds they issued years ago at low interest rates, and some of them they issued more recently at those higher interest rates. The average is
Mhm.
roughly around that 6.1, 6.2 range.
So it's in a bad shape that way, in my opinion, because 6 is quite high. And if they are going to refinance anymore because some of those bonds are expiring, that's going to keep this number stubbornly high for the next 4 or 5 years. When interest rate cuts start happening, at
Mhm.
that point of time, Oracle will be paying more interest than other competitors because they have got a bulk of bonds out there. So that, in my opinion, that's a negative. But we'll see what the viewers have to say about that.
Yeah.
We yeah, so that's what I have here, Sandeep. And yeah, it's difficult to say what's going to happen to Oracle, but they are doing the AI thing now, which is the flavor of the season. So we'll see what happens.
Hey, AI really boosted their cloud revenue and their licenses. So
Yeah, he's
that,
talking about sovereign AI. Larry Ellison is talking about sovereign AI. According to him, most countries would like to have their own AI,
mm,
and that's where he's thinking that he would be able to sell cloud services and AI services. So
uh-huh.
if that happens, and if you look at the countries with higher GDP, if they decide to go for it, then that's a huge market. Instead of going after individual companies, which are much smaller in size, they would have a separate new division, which would just be focusing on countries and trying to sell cloud infrastructure to countries, having entire division that is going to take care of technical support and other things for that country, sales country-wise. So I think it's a big, if it comes true, then it will be big. But on the other hand, people are saying that when you go for sovereign, it's going to be very difficult because different countries have different rules. If the United States says that data stored in US can be accessed by them at any point of time with subpoenas and other things, then many countries would insist that the data stay in their own geography. And for that to happen, that will be a problem. Second is if you look at the 5G controversy, how China was sidelined because of fears of spying and all. So there is a whole lot of issues to be overcome before sovereign cloud can become a reality.
Mhm.
So we'll see how all of this shapes up. And if Palantir is going to do a defense related thing for US, then how can Palantir sell similar technology to other countries? Will the US allow it to do that, or will it be considered as defense secrets, or things that cannot be shared with other countries, whether they're hostile or not? So all these questions come up. And if you look at the semiconductor issue also, there has been a ban on the capacity of semiconductors that can be sold to China, especially in terms of GPU capacity. So NVIDIA has had to dumb down the GPU before they sell it to China. So
Yes.
if we have all these things in real life, right, and if the next president of US is going to be Trump, then he has already shown that it's America first and we're going to have a wall around America. That means all these companies which are thinking of these global aspirations, they'll have to dial down everything and just focus on US and developing the US market. And all these external things will be under tariffs and under bans and things like that. So it's going to be messy. So that's what I think about Oracle's plans. Any other thoughts, Sandeep?
Um, good point about the Department of Defense, where
Yeah.
both Oracle and Palantir, that is one of their largest clients.
Yes.
So, and the Departments of Defense, they do have multi-year contracts.
Yes.
However, that is very what do you call it? There are a lot of macro factors, and whomever is in charge really plays a factor in who how much funding goes to that, and so on and
Yes.
so on. And this external threat of we got to worry about this country, that country, whatever, can really impact that.
Yeah.
So
So
Oracle, Palantir, the external environment, the macro, that is something that can change its revenue.
yeah. So I think with that, I think I should we can bring the video to an end. So the conclusion I think is that Sandeep, what you are saying is right now, if the a share price falls to somewhere around $100 to $115,
Yeah.
then you would be happy about Oracle, saying that it'll be in a good shape. My points was that I think, as you said, average interest rate is around 6%.
Yeah.
So if they issue any old bonds that expire, which obviously would have been in 2 or 3 or 5 4%, that's again going to go into 6. So the weighted average is likely to go up or firm up in the 6% range.
Hmm.
And then all these bonds are issued for 5 years or 10 years or whatever duration. So when the interest rate cut starts happening, the rest of the industry is going to feel the benefits of the interest rate cuts much strongly than Oracle, because Oracle will still be paying high interest rates. So that's the flip side. And also in terms of financial leverage, any company that has a high financial leverage where most of its capital is coming from borrowed funds can actually boost dividends per share because there is less number of shares and each share gets a higher dividend because interest costs are fixed. That kind of company suffers a lot when there is a loss because equity shareholders bear the brunt of it because uh, debtors have to be paid first.
Hmm.
So that's the negative for companies which have got heavy leverage on debts or borrowed funds for their operations. And then finally, the last point was that when you talk about sovereign AI and sovereign cloud and all that stuff, there is going to be the factor of the US government deciding to limit whom you can sell to and what capacity you can sell to, and also requirement of not providing certain technologies in order to maintain US superiority, especially when it comes to companies like Palantir. It's like you're allowing a company to sell the blueprints for the atom bomb. I mean, figuratively. no country would like to do that if they are the only one who have the technology, because it levels the playing field. So those factors will be there. So I think Larry Ellison thinking about sovereign AI could be aspirational, but is it practical? I really don't know. We'll have to see how the political dispensation looks at such things. So that's all, my friends. And yeah, I think with this, we'd like to end this video here. Thanks, Sandeep, for once again stepping up. I know you have been very busy with a lot of personal stuff, but thank you for coming here on a Monday morning and putting the
Hey,
time in here to give our viewers this video. And I
just
hope
for
all
the
of you,
lunar eclipse or solar eclipse.
yeah, I hope you guys have a good time. Go and watch the solar eclipse. And David, your point about the $100 billion debt in Oracle's balance sheet, it was a very good point. We made this video for you, and we'd like to hear your feedback. Put it in the comments below. And we'll catch up with you again in the next video. Bye.
Bye, friendos.